Welcome back Tuesday here on Squawk Asia. We've got a bit of pressure on Asian markets, and that's because we had a pullback on Wall Street overnight. We had the Dow down 0.8, S&P off about 1/5%. Russell 2000 small caps, worst damage there, down more than 1.5%. The only major gauge in the money was the NASDAQ tech-heavy gauge, up about 1/4% there. So some of this is, yes, caution ahead of earnings, which continue to roll out, but also some of the damage could be down to the huge spike we saw in Treasury yields overnight. The 10 jumping about 10.5 basis points in Asian trade this Tuesday. We are tucked just under 420. The short end too is at 402.32, and for some perspective, the 10-year yield is about the strongest it's been in about 3 months right now. All right, back with Francis Tan, Indo-Suez Wealth Management. And Francis, if we could pick up where we left off talking about China. At the end of the day, look, it's going to come down to stimulus and how much, what the dollar amount is, or renminbi amount, right? Wide range being thrown around anywhere from between 2 to 10 trillion, although we had a Caixin report out saying probably more like 6 billion, somewhere in between. How much do you think it needs to be, one? And two, are we going to have to wait until the Standing Committee of the NPC meets maybe at the end of this month to find out, to rubber stamp this?
Right. I'll answer question number 2 first.
Sure.
I would think that it's not just waiting for the NPC, but beyond that. Because at the end of the day, Chinese policymakers are really concerned about stimulating the economy in a big way that we have seen, like we have seen in the United States. They are not someone who says, okay guys, this is maybe 6 trillion or 10 trillion for you, just spend. It's going to cause a lot of volatility in the markets, too much exuberance that you don't want. You want to clamp down on the volatility. So I don't think it's just from the MPC, but it could be a longer drawn period into 2025 that they are slowly coming out with measures after measures, and not in a big way. We call it show hand. No show hand. Yeah.
Okay, all right, fair enough. That's either mahjong or poker, I'm not sure. But anyway, but I mean, hazard a guess. Range of 2 to 10. Caixin says maybe 6 in terms of bond issuance, right? But then we were talking offline a couple of seconds ago, and you mentioned, look, the last time they had to throw a massive amount of stimulus at the economy back in 08-09, right? It was 14 trillion.
Okay.
Do you think it could be? Does it need to be that much?
Right. So to put into context, I mean, back in 08-09, global financial crisis, the Chinese government came with 4 trillion renminbi of fiscal stimulus. But China's GDP was relatively smaller then. But after so many years, China's GDP has grown 3.6 times nominal GDP. And right now, using the same ratio of stimulus to GDP back in 09, right now, as of 2023, it will be around 14.1 trillion to be matching the kind of stimulus that we have seen back in 09. Of course, I mean, right now, there's no one ranging above 10 trillion, but it's just to give you a context of what has been done in the past, which seems to be quite strong during that time to now what will be happening. At the end of the day, it's anyone's guess. It can be a big range, but at the end of the day, I think the government, the Chinese policymakers want to feel upon measure after measure, they need more data. I mean, it's like what the Fed says, data dependent. They will like to see what kind of a reaction or outcome from these measures will be.
Sure. Okay, let's pivot to the U.S. and that big jump in yields that we saw overnight. The 10, I mean, it seems like it was just yesterday. Obviously, it wasn't. It was a couple of weeks ago, right? When we had the 10 and 360, and now suddenly we're looking at 420. What is going on here?
Well, I would say that the period of lower yields that we've seen earlier part of this year was mainly anticipation of a Fed rate cut. Right, and it was, I would say, over anticipation of a Fed rate cut. I mean, if you look at the interest rate futures market, the rate cuts has been too aggressive this year and including 2025. Now it's just basically a correction to that wrong view from the markets, and that's why we are seeing yields in the 10-year moving higher right now. But it should not go higher that much from here, because at the end of the day, it should be guided by the longer-term fundamentals in the US and in the world, which is a disinflationary environment. When the environment is disinflationary, including in the US, rates on the 10-year shouldn't go up much significantly from here as well. All
right. Well, I mean, where would you put the cap? 4.5?
I would say 4.5 will be a scary time.
Oh, okay.
And in fact, if it's 4.5, and we're going to see 4.5 by the end of 2024, you'll be in some nice times to get some bonds into a portfolio. So just look on more on bonds.
So maybe not 4.5, that would be scary. But from 420 where we are now, maybe 430?
430, 440. In fact, now could be a nice level for us to move more into bonds rather than not. Yeah.
Interesting. Okay. Part of this is, look, maybe the economy is stronger than we expected at first, right? Maybe the Fed doesn't need to be as aggressive in terms of cutting rates. The November meeting, the next one, 87% chance that they're going to do just 25, 13% chance they're going to do nothing at all. Where do you stand?
Well, I would say that it's okay to do another 25. In fact, our industrial house view is for another 50 basis point cut by the end of 2024. And further into 2025, there will be another 25 basis point rate cut. And that's about it. Recall earlier, before the first rate cut in September, FOMC, markets was thinking that there's going to be a lot more rate cuts going forward. We were thinking that, well, though there's this inflation in the US, but things are still pretty robust in the US. We still see pretty strong consumption. Retail numbers are still okay. So it shouldn't justify too much of a rate cut into 2025. That's why we held our ground. We'll say that probably there's not going to be a lot more rate cuts than the market has thought. And guess what? Now the futures is pricing back to our forecast.
Okay, what's that going to mean for the stock market when it's trading at about 22 times forward?
Well, I would say the stock market is a little bit more stretched right now, particularly, again, with the US technology shares. I would say that the market is pretty primed for some correction going, especially by the end of 2024.
Yeah.
So just be a little bit beware of it.
Is it going to be yields that cause that correction? Or is it going to be earnings disappointments?
I would say it's going to be a little bit more on the earnings side. At the end of the day, everything, because it's fundamentals, it matters a lot more. And of course, there could be some profit taking right now. Because if you look at the perhaps the S&P 500, it's trading pretty near it's a 2 standard deviation high, which on a 5-year trend. So probably there will be some profit taking.
On the earnings, right, we are focusing a lot on big tech names, chip names. This week we've got TI, next week we've got AMD as well, right? What we've seen coming into this earnings season is the usual game, right? They lower the bar, then they end up beating, they go, yay, we beat, right? Is it different this time around, this season?
Well, I would say it could be still similar this time around, but at the end of the day, if you look at perhaps even the global chips environment right now, I would say that chip sales have sort of been looking to be peaking right now and seems to be coming down. So we'll just be a little bit careful on that on a year-on-year basis. So I would say that the general fundamental sentiments on the ground may encourage more investors to start their profit taking by 2024.
You sound cautious on tech.
Sorry?
You sound cautious on tech.
I was now a little bit cautious on tech based on current pricing, actually.
Okay, Francis, stay right there. A lot more ahead with Francis Tan from Indo-Suez coming up in just a bit. We'll take a quick break. We are back in 2.